All right, welcome back. My next guest, simply put, he's a money man, right? He helps people with their longer-term investment objectives. Now, he's brought to our attention a lot of the things that he sees when clients come in to get investing advice. Now, the longer-term picture, I think that could be getting a little murkier here. Now, along with today's hotter-than-expected CPI numbers, we're also expecting a big rebound in retail sales. And the New York Fed came out with this. They find that medium to longer-term inflation expectations have jumped even amid this latest surge in stock market optimism, right? The New York Fed reported that in February, there was a sharp rebound in longer-term inflation expectations, rising from 2.7% from 2.4% at that 3-year time horizon, and jumping up to 2.9% from 2.5% at the 5-year time horizon. While the 1-year inflation outlook, well, that stayed flat for the third month in a row, and that's stuck at 3%. Now, investors starting to smell what this economy's cooking. Now, we've seen a run-up in stock prices because of an expectation of rate cuts in 2024. From December 13th of last year, traders have been almost giddy at the idea of cheaper money. But what happens if this doesn't happen? Where should I be looking to invest when trying to insulate myself from the market, finally coming to terms with fewer or maybe even no rate cuts in 2024? Now, we know just the guy to ask. Please welcome to the show the money man, Craig Bolanos, coming to us from Chicago. Thanks very much, Craig. I thought this would be an interesting topic, where to hide when the market finally wakes up to, well, maybe there's a big assumption there that we're not going to get any rate cuts on my behalf. I get that, right? There are a lot of folks out there that still think we're going to get 2, maybe 3, maybe one of them's political, maybe one of them's not. But if we keep getting stuff like we did today, it's going to be hard. So what do we do?
Well, the first thing I want to call out is, according to my gambling app, the line for the rate cuts is 2.5, right? That's tough to bet the over-under because the line is 2.5 in the sand. But I think there's a couple very simple things that everybody should think about. Number one is we always focus on equities, but how many investors have large portions of their money committed to the bond or the fixed income market? And I'm calling on all investors to wake up to the fact that these rate cuts were widely digested into the bond rally that was year-end 2023. And as a result of that, I don't think people need to be chasing duration here, which is such a popular trade with everyone I speak to. I think people should just be rolling treasuries and other forms of high-quality fixed income on the short side of the curve because you got great coupons and you don't want to be disappointed.
I did that with my family's money, right? And we had Nancy Tengler on the show, I believe it was yesterday, and she said that she's laddered bonds for the first time in a long time. She said she had really been part of the market, and that's an interesting answer because I didn't think that's where you were going to go with this. But I think you're right. There probably are some decent places to put a percentage of your money, maybe not all of it, right? But that's going to be. Back in the day, you could get 5, 5.25, 5.5, depending on how short you wanted to go. I haven't looked at the 1 month, 3 months, 10, 8, 6 month yet, but that is a great answer because it's safe. You get to, depending on what you invest in, you might get a tax break. Those are the types of things that I think our viewers should actually know about. Now, what about the opportunity lost cost, right? What do we have to worry about there? Because there's going to be some folks that say, no, you should be in the market.
Well, and I agree, as a practitioner, I do think that people should be in the market, but I think people should start looking at the fact that the technology component makes up more than 30% of the S&P's weighting. And I think about where will the money eventually be going? You and I have talked on your radio program on a couple of occasions. The energy sector, energy makes up 3% of the S&P composite. That's why energy is so incredibly underowned. But I think about a couple of things. I think about seasonality today. I think of valuation, the PE. I think of the dividend and cash flow. And I think about the fact that I just learned overnight that China is not dead. There is still some growth and some inflation in China. And if they can do a stimulus package over there, the world's largest country who imports oil is China is going to want more. I think all of that bodes well for the energy sector. And the theme for the remaining 9 months of the year is quality and dividend growth. And that leads me into places like energy.
I love that too, but do you think energy's been beaten up a little bit politically speaking because of the ESG movement and people just don't want to hold that stock, or is it just been unloved because of other reasons?
Well, again, I serve families. At the Wealth Management Group, we exist to help people get retired and stay retired. And let me just tell you what's no longer in my inbox. Let me tell you what's no longer getting mailed to my office 5 days a week. I am not seeing a ton of investment momentum in ESG. I'm not seeing a ton of investment momentum in DEI. In fact, I'm not even seeing Larry Fink. We all know who he is. I'm not seeing that as a part of his prepared talking points anymore. So is there a subtlety of a sea change evolving? Scott, I got to be honest, I think there is, because people are wondering about the fiduciary standard and voting people's proxies. So yes, there's been a war that has suppressed the price of crude, but the truth is, I think energy stocks as an investment and a theme probably makes sense here.
I agree with you too. And that sea change that you're feeling, we've been seeing that here on this network, because it doesn't have to do just with energy. I mean, there's some fertilizers involved with that talk with ESG and other things. And you can see with your own eyes the news stories coming from Europe with the farmer protests there about what's been happening to their livelihoods because of what a lot of these governments have put through as far as ESG mandates. And so it's been good to see. I think you're right, because it started there, and hopefully we can keep it going here. But that was great. I mean, you didn't go anywhere near I thought you were going to go, but I loved every second of it. Craig, that's great stuff. Thank you very much. Talk to you Friday. Craig Bolanos, he's with the Wealth Manager Group, co-founder and CEO in Chicago. All right. By now, I got my go-tos, right?